Anil Sahgal of iSave joins us now to answer your questions on insurance. Anil, thank you so much for spending time with us.
Thank you.
Deepak Jain has written in from Delhi saying he has an annual income of 4.2 lakh rupees. Now, he invested 12,000 rupees of his taxable income in the LIC Jeevan Saral plan. He wants to know now where he can invest another 48,000 rupees to get good returns. Now, he wants to know if it's a good idea to invest 20,000 rupees in the HDFC Sampurna Samriddhi insurance plan. And alternatively, he wants to know if he should opt for an infrastructure plan for that tax exemption. Which would be a better idea, Anil?
Deepak, first of all, your sum assured is not in line with whatever your income is. So the first thing to consider is that, look, around about 20 times of your income you can insure today under term plans. Minimum of 10 times your annual income is something that you should certainly have as insurance. So first thing to do is make sure that you have a term plan which provides your family with the security in case something happens to you. The second thing then is to look at what is your risk profile and your risk appetite, and whether you can look at market linked investments or not. The HDFC plan that you mentioned is a traditional endowment plan which offers a reversionary or an annual bonus. Now, you can obviously look at this if your risk profile is low. You can also look at alternative investments like the public provident fund, which you can go up to 70,000 per year, and that on maturity is also tax exempt. So if you're not looking at market linked investments, look at options like the PPF as well, which can give you help you to accumulate what you need to on a tax free basis. If you're looking at market linked investments, so you could look at any kind of a mutual fund which meets your requirements. Take the advice of a financial advisor. Based on a risk profile, take a decision on what funds would suit you.
Amit Kumar has written in, he's 36 years old and he's invested in the HDFC Young Star Plus in 2007. He pays a premium of 60,000 rupees per year. Now, he's paid 5 premiums so far and he's unhappy with the returns he's getting. He wants to know if he should continue investing in this policy or should he invest the money in the public provident fund instead.
Well, the HDFC Young Star Plus had a very high allocation charge. So in the first year, you would have only got allocation of around 40%. And that would have impacted your fund value in the first few years of operation. The thing to remember again in this case is that if you were to redeem or you were to withdraw from the fund at this time, then there would be a surrender penalty. Consider whether that surrender penalty, what the amount is and whether it makes sense for you to withdraw. In any case, at your age, you should be having a significant or sufficient amount of term insurance to provide for your family in the event of death. So that is something that you should be doing. A ULIP plan really is not a solution to take a large sum assured for yourself. So having a combination of a term plan with alternative investments is a good option in any case. Whether you do it by discontinuing your existing plan or continue your existing plan has to be a function of whether you need to save for your child and whether the plan is meeting the requirements that you had planned for. And again, what is the cost of you withdrawing from it at this time?
Our last question comes in from Jennifer, who's written in saying she's been investing in the SBI Life Pension Plan since 2008 with a premium of 25,000 rupees per annum and has till date received only 4,000 rupees as returns. Now, she wants to know why the returns have been so disappointing. She wants to know if it's time to book out of this plan. Anil.
Jennifer, the plan that you're talking about essentially offers it's a retirement accumulation plan. But B, it also has a sum assured attached to it, and that sum assured can vary depending on your requirements. The mortality charges for whatever sum assured you've taken would be getting deducted from the fund value that you are accumulating, and that would have a negative impact. Also, obviously, if you've taken a market-linked plan, the equity markets have not performed very well over 2011, 2010. And that would have had a negative impact as well, which you might have seen some appreciation in the recent run-up. The key thing to remember, however, is that pension plans are long-term plans. If you are saving for your retirement, don't take them as short-term investments. Don't try to take decisions over a 3 or 4 year period. By all means, if your fund is underperforming, take a decision, switch to another fund. If your risk profile is not matching any volatility that you might be seeing, take a decision based on that. But don't take early decisions and clearly consider all the factors that might be impacting the fund value that you have.